What's going on, everybody? My name is Jason and I'm here with X91Investing. In this video we're going to be talking about exchange rates, the way currencies interact with each other. We're going to take a very basic example of like when you go to another country on a holiday, or if you go on business, or look, it's just basically when you take one currency and convert it into another, the exchange rate can change, and then when you want to get your native currency back, the rate could have changed against you or in your favor. So the currency of the place you're in might have weakened, and you might end up you'll end up with less of your native currency, or the currency that you're holding currently on your holidays. When you go to convert that back, if that's strengthened, you're going to have more of your native currency when you return home. So that's the basics of it, and look, we're going to get into it now, so come on. Right, so lads, we're back in Microsoft Whiteboard. We've seen this all before, previous videos, the introduction to FOREX, in the trendline video we were in here, in the support and resistance video we were in here. So look, as before, look, we're going to be talking about the way the currencies work, exchange rates and all that. So we have to imagine that we are living, say we're going to take the dollar against the yen, USD JPY pair, right? So if you're living in the US and you want to go to Japan, you go to the airport or wherever, you go to your bank and you want to exchange money. You're going to give them your money, and they'll return you at a particular rate the native currency to where you're going. So if we're going from the US to Japan, right? So if we go put in USD to JPY, right? And the rate currently is $1 will get you 108 yen. I'm going off of the value right now, just as I was recording this video. I took down the values. So if we're going and that's the value, right? And we want $100 into yen. We're going to have 10,800 yen, right? If we go, there's actually two lines on the yen. So we have $100 will get us 10,800 yen, right? But when we come back, right, say we're there for 3 days and the exchange rate can change, right? So obviously that's how we make our money in the markets. But if we strip it back to bog standard, the way things work in a practical sense outside of trading, the exchange rate 3 days later is now $1 will get you $1 will get you 104 yen, right? That's the new price, 104 rather than 108. So the dollar gets you less yen, so that the yen has actually gotten stronger, right? Same thing if you went to Mexico and you were using the pesos. There's currently, say you were $1 would get you 20 pesos or 25 pesos or 18, 15 pesos, whatever. That's the kind of rate you're talking around, 1 to 20, 1 to 18, 1 to 15, 1 to 25. That's the kind of way. So it's the same thing here, but when we're coming back, it's a new exchange rate. And so now but we didn't spend any of our money, just for simplicity's sake. This was our money for our pocket. We're on a business trip for 3 days. We're coming back now. This was just money in the pocket, but we actually just paid for everything by card or whatever. For some reason, we didn't pay for it. It's not important. So we take the 10,800 yen that we had, right? And we divide that by the new rate, right? Which is 104, which will give us roughly about 103.85 dollars back, right? So by the yen strengthening, we had the stronger currency, so when we convert it back, we're going to get more of our native currency, right? So we actually made $3.85, right, profit based off of that. This wasn't intentional, or sometimes it's denoted with an up arrow like that. So we made $3.85, right? That's, look, you're talking, like in yen, 40 pips, and let's say that would technically have been a short trade if we were trading, but it's not really important when it comes to really stripping it back as basic as this. So if we go and take, for another example, a more, say, relevant one to me, the most traded currency pair in the world is the euro dollar, right? So we have the EUR USD. €1 gets us right now at this point in time, just rounded to $1 and not 81, Jesus Christ, $1.18, right? This is more what we'd be looking at. The euro or the dollar yen is a little bit more obvious with the huge, $1 is 140 or 100, but it's 108. If you're doing pound to yen, it's 140, 150 yen to the pound, because the pound would be, say if you're trading the pound against the dollar, you're talking, less than a dollar for less than a pound to the dollar and whatever. So we have £1 is equal to 0 point whatever or 1 point whatever. We'll get into it in more detail. So the euro dollar, right? We want €1,000, right? We bring €1,000 and we want to get €1,000 converted, right? €1,000 at the new rate is going to be $1,180, right? When we convert it, because we're going to get more dollar value from the particular. When we convert it, the dollars we'll get more dollars from a numbers point of view than we would for the euro. But when we come back, the actual price, so the quoted, so when we see this is the euro against the dollar. This is €1 will get us in dollars, right? When we come back, that rate is after changing. So we come back, we have the same amount. We still have our €1,000, but the rate is now €1 is equal to $1.23. It's a big jump. So it was a massive change, big massive market rally or whatever. That changes at a new rate. So we bring our $1,180 back to the exchange, divided by the new rate, right? 1,180 divided by 1.23. We come back and we actually have lost a considerable amount of money. So we have 959.35, right? So we went off and came back, say, 1 week later, and it was a huge resurgence on the dollars from the dollar point of view, and basically we actually have to front more euros to get more dollars. The dollar is more expensive. So when we were looking at it in the first example, where we had USD JPY, right? So we have the USD JPY, but now we have EUR USD. The dollar has changed place. In this one, we were going from dollar to yen, right? But in this case, we're going from euro to dollar. So the dollar is in the opposite position. The dollar considerably increased in price. When the dollar is in the quoted, if the price goes up, the dollar is increased in price. If we look at it with the yen value dropped. The yen was worth more, and it was, you were spending more dollars to get more yen. You spent more. You had a certain amount of dollars. You were getting less yen for it. So now we have a certain amount of euros, and we're getting more yen, or we're getting more dollars. On big mismatch of currencies here. So we actually lost 41 euros and 64 cents, 65 cents, 60 whatever the thing is. I can do it out, but you can understand we started with 1,000 euros, and now it's gone down. So that's a upside down triangle for that one there. So we actually lost money. So it's a fairly simple science when you think about it, but it's very, very fundamental, and I hope I'm not after confusing it too much, but that's essentially it. You go away, you get a certain rate, you come back, and whether you've spent it or not, you're going to get a certain amount back, and whether it's after going up or going down in value, so you've actually converted to the dollar. But the dollar, so the whole thing here is you went away with the money, you got the money, but when you held the dollars, it was devaluing. So then when you converted it back to the euro, you got less euro for it because it devalued when you were holding on to it. But if you actually had the euro and if it was the other way around, you would have actually made money, if you get me. So if the currencies were swapped, you don't have a dollar euro chart, it's done euro against the dollar. So that particular movement would have been bad for someone that was holding dollars, but good for someone that was holding euros, because the euro was strengthening versus the dollar, rather than, so in this instance the dollar weakened because you were getting more dollars for the amount of euro that you were spending. So this one's going to be considerably shorter than the previous videos, but this is fundamental. This is very, very basic stuff when it comes to the currency markets. So this is 2 examples of various currencies. We could do another example, but I think that's without to be completely dragging it out too much. That's the kind of way it goes. So look, lads, thanks very much for watching. And if you have any suggestions for different videos you want to see, just let me know. I can do more of this type stuff if you want to see it. Don't forget, we had the PMA session last night, Sunday evening. So every Sunday 7 p.m. we have the PMA session. I cover one particular topic, just random, to do with either stocks, forex, cryptos and whatever. So we actually did a bit of a crypto session last night. I gave a little bit of sentiment on Bitcoin. We went into what brokers, so we were talking about brokers. I will be bringing a dedicated video, but it was something that someone asked in the chat, so we actually went on a little bit of a discussion about brokers. But yeah, sure, look, if that's something that interests you, definitely maybe check it out. Sundays 7 p.m. GMT, so I don't know what time that would be in America or whatever, but America's time is lagged behind Irish time by quite an amount. So we're ahead of them. If you're going to Europe, they're ahead of us and whatever. So just look it up, GMT 0. Well, the clocks will be changing soon enough, so things will be changing. We'll be back in GMT +1 or whatever. We're in GMT 0 either way anyway now. So yeah, spring forward, so we'll be in +1 again. So it'll be, I don't think it should change things too much. It'll still be native to me 7 p.m, but it could change for other people. So yeah, look, thanks very much for watching, lads, and I'll see you in the next video.